and welcome. We are at Eastern Washington University doing the CFA Challenge this year. We appreciate the opportunity. My name is Andrea Avenger. This is James Breen. We have Stephen Gustafson and Will Harrison. And this is Itron Incorporated.
We are recommending a buy because our price target is $66, which represents a 21% upside as of January 18th. The key catalyst to our recommendation is stable revenue outlook, OPEX control, margin increases, and strong book-to-bill.
Itron was founded in Hauser Lake, Idaho, 1977, and is currently headquartered in Liberty Lake, Washington. Itron's sole purpose was to make utility meter reading easier through innovative products and a diverse portfolio, including their measurement and sensing department, which is all of their gas, water, and electric meters, the network and communication, which is the data collection and the water data management, and software and services, which includes any analysis software, any customer and market research, as well as any strategic planning.
Of the quarter's five forces, the most standout threat is power of suppliers, as noted with the recent problem with the MLCCs. However, the strongest element in their court is the threat of new entrants, as they have close margins and a strong market share. As you can see on their market saturation there, the red in that circle, they command a 31.8% of the market share in the smart meter producers. Of their major competitors being Landis & Gyr, Honeywell, and Xylem, they are standing in the forefront of that. They also have a very low to moderate economic sensitivity.
At the end of Q4 in 2018, Itron completed some restructuring where they centralized the electric and gas water segments into three growing industries. Outcomes and analytics, networking and communications, and device solutions. Revenue estimates for those include 50% for device solutions, 40% for network and communications, and the remaining 10% outcomes and analytics. Of those three segments, outcomes and analytics is supposed to grow the fastest with the industry rate of 12%.
They have a fairly new management team in the last few years. The big focus is deleveraging, trying to get that the debt down. They also are working on this go-to-market strategy, which has been kind of helped out with the new management team. Each of their different boards has this implemented into it, the go-to-market strategy. They have different focuses for each one. So.
Our competitive strategies involve the segmentation that we mentioned earlier into those three departments, which will reach customers through a go-to-market strategy. Itron understands the importance of the R&D funding in order to maintain a competitive advantage. As soon as a competitor can make something cheaper or more efficient or faster, they can lose a part of that market share. Additional return to the merger and acquisition strategy requires them to get that net leverage down to about 2 times in 2020 as their goal. Itron also implements a value engineering strategy for their manufacturing and production. Value engineering is intended to obtain the greatest production value at the lowest cost possible while delivering a high value product.
The majority of Itron's revenue comes from North America. Based off their 10-year graph of revenue and net margins, it's been extremely stable over the past 10 years. They have a strong book-to-bill, and it keeps on getting stronger, illustrated by post earnings in Q4 2018 to a 1.3 book-to-bill. And their historical growth rates are 10.89%, but based off recent acquisitions, we expect a 25% growth rate over the next 5 years. Their asset turnover has been 1-to-1 as far as revenue generation. Their debt to equity was 0.75 in 2017, and they have been recently financing their operations through more debt with a 1.43 debt to equity ratio based off the TTM from Q3 of 2017 to 2018. And they have strong free cash flow, pay down their debt, and it's shown through their EBITDA graph. They're going to use their free cash flow, pay down debt, increase EBITDA over the next several years.
All right, these are inputs to, we did 2 different valuation models, and these are our inputs. We used a little bit of a higher beta at 1.3, but based on recent market activity, it seemed appropriate. And you can see a risk-free rate, risk premium. We have a capital asset pricing model of 10.8% and a weighted average cost of capital just under 8%. And these are more inputs for our discounted cash flows model that we did also. Long-term growth rate of 5%, 5.5%, 5-year growth rate of 9%. Right now, their enterprise value is sitting at about $3 billion, which is 12 times their EBITDA. And so on the next slide here, I think what we did was we took that 12 times and projected it out over to the year 2021 under the assumption they can get their debt paid down to $700 million and get that market cap up to 3.32. And then when we discounted that back by the capital asset pricing model, we got $61 a share. And this is a discount cash flows model. Just takes them to start with 2017, and we're using that 9% growth rate, and then discounting that back by the capital asset pricing, or I mean by the weighted average cost of capital. Sorry, we got $70 per share, and kind of factor in both of those together a little bit, and we got we came up with our market value of $66 per share.
That being said, I stated earlier, strong free cash flow, stable revenue outlook. They're going to be deleveraging over the next several years. And like I said, their book to bill is 1.3 to 1. And their earnings are getting stronger despite having weaker earnings in Q4, unexpected due to market conditions and policies, foreign policies like tariffs and Forex influxes in the euro to US dollar.
Investment risk factors include uncertainty in the utility industry, as well as government regulation, the uncertainty in tariffs, failure to maintain that competitive advantage in R&D, as well as vendor and supplier hiccups, and then of course, currency exposure.
Any questions?
I'll just go right off the last thing you mentioned there, currency exposure. Can you guys talk about how currency changes affect them?
Yeah, so right now they're hedging for a 1.14 euro to US dollar exposure. So, I mean, if US dollar keeps on getting stronger or if it gets weaker, that might change their revenues over the next year.
How
Maybe 2-3%.
up or down, depending on what direction? I guess if the euro strengthens, how does that affect their revenue?
The US dollar not so good.
So Itron came out with 2018 year-end results and 2019 guidance a couple days ago. I know that's after you had to turn your slides in, but I was just curious how 2019 guidance and 2018 year-end, especially with 2019 being below analyst consensus on non-GAAP EPS, how does that play into your analysis, or does it change your outlook for the company?
Yes, it does. We are going to be more conservative based off our evaluations because, like you said, guidance was off by quite a bit as far as revenue and EPS at 265 non-GAAP earnings per share. So we are expecting maybe a $3 pullback in our evaluation overall evaluation.
Price
Itron.
target?
Yes.
Something you guys, and maybe I missed saw because the slides went by pretty quick, but did you have it over 13 times interest coverage? From my,
Okay, so our debt coverage was like on the slide, but that was meant to be interest. It was an Excel spreadsheet error, and I didn't catch it before we turned it into the slide.
oh, okay.
Yeah.
Yes, because I'm showing it 3, so.
Yeah.
Okay. Um, On the company's most recent earnings call, they mentioned that PG&E going bankrupt could potentially be a positive for the company going forward. I kind of scratched my head on that as an analyst. Why might that be?
Switching companies because a lot of what caused that devastating fire was PGE's. I believe it was one of their smart meters or their basic.
Dummy?
Yeah. So they might be switching companies, and they think PGE going forward, going bankrupt, is not the company they want to do investments in California moving
So
forward.
give them an opportunity to take market share.
Exactly, yeah.
That's interesting because they just brought that up. I just saw that on the news this morning that PG&E just admitted that that might have been their fault. They might have caused that fire. So.
As well, this will be last, and I'll hand it off to one of the other panelists here. Oftentimes when companies do large acquisitions like they have over the last couple of years, they'll take like a big bath accounting quarter, and it's kind of, Wall Street mechanics, right? Where you go do the big acquisition right off the goodwill, and then it elevates your ROA going forward over the next couple of years. Do you guys feel like there's a risk that they take a big bath accounting quarter where they write down a ton of their goodwill? Or is it such a sweetheart acquisition that that's okay?
There's certainly market risk because they're moving from traditional low margin business like dumb meters, smart meters and such, and they're moving more toward analytics and more tech, I guess, based segments. So there's always more of with greater return, there's greater risk, right?
So you mentioned some of the higher input costs from supply chain and potential tariff impacts. Can you talk a little bit more about how you factored those costs into your outlook and valuation?
Can you repeat that one more time?
Oh, yeah, of
Just about
course.
how the tariffs and taxes affected the.
Yeah, the supply chain, you mentioned higher supply chain costs.
Yeah, it's gonna.
And higher tariff costs. So can you go into a little more detail about how you factor that into your analysis?
Well, I mean, it's higher input costs is obviously gonna lower the evaluation due to higher input costs. So you're obviously not gonna get higher net margins or profits. Yeah.
Okay, so you see it as a long-term, a short-term or a long-term risk for the company?
I'd say it's a short term, 1 to 3 years.
One, when you were looking at the comps, one company that I've seen come up a lot with as being a comp for Itron is Badger Meter. Is that a company that you guys came across at all? Or, because I didn't see it included in you had Honeywell and a couple others, but not Badger Meter. Is that something
Came
you guys
across
saw?
I don't.
Badger Meter, I did, but I felt like the market share wasn't necessarily competitive to Itron. I feel like they're a lot smaller industry, and they weren't focused more on this networking, which is like the growing expansion within Itron.
Yeah, and that traditional segments that Badger and other, companies like Itron are in is low net margin, and they're, as you can see by like their guidance, revenue's not going up. It's going up in the more like networking and analytics sectors. So, I mean, there's not much competition. It's a tight niche competition as far as market share in North America.
Another thing, he was talking about kind of the big bump up in goodwill through the acquisition of Silver Springs. I saw along with that pretty big jump up in amortization.
Mhm.
And, you know, there's a few different ways. Companies, a lot of times they'll back that out and, you know, in their adjusted numbers. How do you guys account for amortization in your forecasts? I guess I can give you guys a little bit more help with it. It's a big adjustment.
Yeah, it was
You know,
like 5.
Non-GAAP earnings or from GAAP earnings to non-GAAP earnings. You know, are you guys using in your models adjusted numbers or GAAP numbers? GAAP numbers look a whole lot worse than adjusted numbers.
Yeah, definitely.
You know,
Most of our models were all non-GAAP. Pretty much. Yeah, we didn't really take that. We tried to use EBITDA as much as possible. So
And from a geographic standpoint, what areas in terms of, say, North America, South America, Southeast Asia, what areas do you feel offer the greatest long-term growth opportunity for the company?
North America, I would say. We have a failing infrastructure. I think there's more opportunity there. We have a strong presence as is. I think that would be, especially in the conversion to smart cities and like implementing the active grid. I think North America has the advantage for Itron.
And there's current political tensions and market conditions in South America that aren't favoring doing more heavily investing in that geographic area as of right now. That might change in 3 or 5 years.
The company announced that their CEO will be retiring at the end of 2018. Did that play a factor in your analysis of the company? Do you see it as a risk or a potential opportunity?
Unfortunately, I think that information came out after we submitted our documents. We didn't encourage that into our total analysis, but I think going forward, no, I feel like Itron has established such a strong strategy towards the new segmentation that maybe without his guidance, Itron will be just as successful.
In your Porter's 5 Forces, you showed the power of buyers or bargaining power of customers as being a really low risk. Can you guys kind of explain why that's the case?
So we took that stance based off of the contract work, and that with each contract, there are a large number of units sold with it. So having the contracts would pay for itself. That was the assumption going through.
Pretty much wraps us up. We got 4 seconds left, so great job, everybody.